Expect more rate hikes in 2023. That's the message the Fed is sending, indicating that the fight against inflation is far from over. The Fed's 50 basis point hike at the December meeting caps a year that saw the central bank raise rates by a collective 4.25%. The benchmark interest rate is now at the highest level in 15 years. But Fed Chair Powell says that they have more work to do and that the Fed will stay the course until the job is done. And the big question going into the new year is, can the Fed tame inflation without breaking the economy or the markets first? Well, my next guest was early to predict this high inflation in the US. He warned in October of 2020 that loose fiscal and monetary policy would cause the highest price hikes in 40 years, a forecast that has indeed materialized. George Seay is the founder and chairman of Annandale Capital, a global investment firm that manages capital for clients all across the country. George's fund directly manages over $1 billion and advises on over $4 billion of investments. And this year, Annandale has more than beat the markets, with 6 funds with an over 40% annual yield, several over 50%, and one Annandale fund is up over 150% for the year. George is also a nationally recognized speaker, civic leader, and veteran political campaigner in the great state of Texas. But joining us today from the great state of Colorado, George, so good to have you join us here on Kitco News.
Thank you, Michelle. What an introduction. I want to bottle that up and record it and reuse it in the future. That's very kind of you. And yeah, we've had a very blessed year leading into the holiday season. Most people have not. It's a sobering year for the economy, for the financial markets, and for people who make important decisions related thereto. And even more importantly, since we're not in recession yet, or at least we haven't been in the last quarter, what Chairman Powell and the government does next year to try to give us a soft landing and not an extremely hard landing instead.
Well, George, it is indeed a factual introduction, and that is why we have you on to give us your outlook for 2023. We will be discussing the Fed. We will get your macro outlook. And of course, I want to ask you what you think will be the best and worst performing assets in 2023. But before we get to that, let's start off with the Fed. And at the meeting last week, as expected, the Fed hiked by 50 basis points. That is a slowdown from the Fed's recent pace of 75 basis points. And Powell seemed hawkish. He said that he anticipates ongoing increases will be appropriate to return inflation to 2% over time. That was the message from Powell. What was your main takeaway from what we heard?
Michelle, it was less Chairman Powell and more the reaction of the markets. I think the markets have been getting more and more optimistic that we're getting near the end of the Fed. But I think they gave up the ghost a little bit after his comments. He went on and on and on about how he would do whatever it took. And I think they lost heart. And I think sometimes investors like to be over optimistic and see the world through rose-colored glasses. And the reality is, Chairman Powell said, I've got to chop a bunch more wood. And whether that's another 3 months, another 6 months, or another 12 months, no one really knows. But the traders sold the market off sharply and has been in every trading day since.
Well, Chairman Jerome Powell does seem to be intent on channeling his inner Paul Volcker, does seem to be committed to staying the course. He did indicate, though, that the pace of rate increases going into 2023 are not going to be that important. But what we should be focusing is on how long a restrictive policy is in place for. That is one of the points that he made that really stood out to me. But we put together a compilation of some of the highlights from the previous meeting and the press conference that followed. I want to play this for you and get your thoughts on the other side. Let's watch.
We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. We're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. The committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. We've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. We will stay the course until the job is done.
All right, George. So Powell's saying it's no longer the speed. They will stay the course until the job is done, giving an outlook for 2023. What do you make of that? What are you expecting to see from the Fed next year?
Well, Michelle, it's been interesting because I think Chairman Powell has gotten a lot of criticism for being behind the curve in how fast he reacted to inflation and then the measures he's taken. I don't really think that's very fair because it has been 40 years since we've seen inflation of this magnitude. And I think once he did begin, he was extremely aggressive. We've seen several 75 basis point hikes. We've seen some 50 basis point hikes. I think he's channeled, like you said, his inner Paul Volcker very, very rapidly. But one thing he is hinting at right now that I think is a mistake is I think he'd be much better served by early next year doing one more 75 basis point hike and stopping right then and announcing he's going to stop and that he's going to survey the market for a good 4 to 8 months and see how that plays out. And if inflation is tamed, he might even start cutting rates to give the economy a tailwind from Federal Reserve policy instead of additional hikes. But if inflation still continues to rear its ugly head, open the door to do some things in the future. I think this gradual process that he's hinting at would be a mistake right now, both for Main Street and for Wall Street both.
So one more hike and then hold steady. Do you think that that's likely to be what he does?
I don't. I think he's telegraphing he's probably going to do 50 and then another 25. And I think this is starting to be death by a thousand cuts, though. I think investors and traders and the market is losing a bit of heart because it rallied pretty heavily into December, hoping for a Santa Claus rally. And now we're down 6.5% in December. So I think he needs to get more aggressive and then signal clearly that he's done for quite some time.
Well, you said that people are giving Powell a hard time for being behind the curve here. I mean, this was also the guy that was trying to assure us that inflation was transitory. How much faith do you have, George, that the Fed will be able to tame inflation and can steer the economy back on course here?
Yeah, and you look at the hand he's been dealt. He was dealt a pandemic hand on the front end of the inflation hand, which was incredibly difficult to manage. And he was extremely aggressive the other direction in handling that. And I think that it behind closed doors, maybe over a Coca-Cola or a beer, he'd probably admit that he was 6 to 12 months late in combating inflation and rested on his laurels a little too long. But now he really has gotten aggressive. And I think he will continue to do that until inflation is tamed. And we all know that monetary policy is a very, very blunt instrument and can rectify inflation given time. Paul Volcker proved that. If you look at what's happened so far, though, he's got a range of about 5.25 to 5.5, somewhere in that range once they finish up for now. And when you think about where Volcker ended up, he was in the mid-teens when he finished. So we are a far cry from that and in a much better position.
Well, a couple of points that I want to hit on there. Firstly, the markets have been banking or hoping for a pivot in 2023, a pivot or at the very least a pause. What are your expectations for a Fed pause or a Fed pivot actually reversing rates sometime in 2023?
Yeah, that's the poignant question for investors. I do think that a pause is highly likely after the first 6 months of the year. Whether we get it in March or in May or in June or July, I really don't know. But I do expect a pause. Unless the economy falls off a cliff, I do not expect a pivot. I think the Fed's going to watch and wait for a while. And this economy has proven a lot more sustainable, enduring, resilient than I think a lot of people expected. A lot of the perma bears, very, very wise investors who've made a lot of money over time but have been expecting a very bad market for a long time, have been anticipating a 50% drawdown in stock markets, and they just haven't gotten it because the economy's been more resilient and investors have been more resilient. So we will get a pause, but I would not anticipate a pivot unless things absolutely fall apart. And I don't think we're seeing signs of that yet.
Okay, I mean, and that's been the question. Can the Fed continue to do this without breaking something, without breaking the economy? I'll tell you what, Goldman Sachs seems to think so. They issued a macro outlook stating that the U.S. is likely to avoid a recession and that GDP will grow by 1% with core inflation winding down to 3%. Most forecasters see a 65% chance of a recession in 2023. What does George Seay see? Is a soft landing still possible in 2023?
It most definitely is, but I would warn your listeners and your viewers that Goldman Sachs might as well be the lady on the corner with a crystal ball trying to reach your palm and guess your future at the same time. Predicting what the economy is going to do and what the stock market is going to do and what interest rates are going to do is impossible. Nobody gets it right enough to be really good at it. But I'm optimistic like them. I think a soft landing is still a possibility. And I also think that most people forget conveniently, because politics got in the middle, that we fulfilled the classic definition of a recession.
Yeah.
This year, we had 2 quarters of back-to-back negative growth. So we've already taken some medicine. And I don't think we're going to take really harsh medicine soon. It may come, but I'm optimistic like Goldman is for now.
All right. Well, we had headline inflation at 7.1% in November, core inflation coming in at 6%. Do you think we've reached peak inflation?
Well, I could get out my crystal ball and give you an expectation. I do think we've reached core inflation, but I could easily be wrong on that. I think a lot of it depends on fiscal, monetary, and global economic policy across all major policymakers in the developed world and in the G8. And I think there's got to be a lot of coordination. And if you look at Europe right now, Europe is getting very, very hawkish. And previously, they were a lot more dovish than the Fed was. So what if the Fed starts easing off the gas a little bit in terms of putting brakes on the economy and trying to slow down growth, and then the European Central Bank starts doing it on their end? So I think there's going to have to be, it's a tap dance, and it's going to take a lot of skillful dancing by all policymakers to give us a soft landing.
Yeah, and as you say, I mean, we focus a lot on monetary policy, but fiscal policy certainly had a huge hand to play in all of this. And can we even control inflation if you've got Congress continuing with some more bills, some more stimulus, raising the debt ceiling even further?
Well, you just hit on a really key point from domestic policy standpoint and the markets here in this country, which is we now have gridlock. We now have the opposing political party in charge of the U.S. House of Representatives, which means government will be able to do a lot less. And a lot of the very intense spending that President Biden and his allies in the Senate still want to do will not get through the Congress. They will probably still try to do quite a bit of things, stimulating through executive orders and through the executive branch, but they've been put in balls and chains, so to speak, and have been caged up to some degree. So there'll be a lot of gridlock. There'll be a lot less government intervention, and that will fight inflation very, very effectively, because the fiscal element of inflation will be neutered, so to speak.
Okay, well, George, the S&P is down around 20% year to date. The Dow is down around 10%. How much more of a drop do you expect for 2023? Have we seen more or less the worst of it?
You know, Michelle, I think we've got some more medicine to take at the early part of this year and potentially further into the year. The Fed's not done tightening yet. The bearishness in the market during typically a very bullish time of year, the Christmas Santa Claus rally season, has been very poor the last 4 days. We're down in December 6.5% now, which is a major drawdown, which is usually a very positive month. So I would encourage investors to be conservative, patient, and resilient in the first half of this year, because we're probably going to have some more volatility, some more drawdowns, and stocks that have had very high valuations for a very long time probably have more pain to come. But the good news is the Federal Reserve is probably a lot closer to being done tightening than at the beginning of this cycle. And they're probably going to get it finished sometime in 2023 and may even start cutting rates again towards the tail end of that year or in 2024. Markets anticipate that, and they're likely to rally going into the second half of the year. So there's a lot to be enthusiastic about, but the coming months will probably be pretty challenging first.
So putting aside any major black swans and unforeseen events, we've had a lot of guests that say we are not done yet. The bleeding is far from over. Expect another 20% or so in 2023. Do you see that? Do you see double-digit declines for the S&P 500 overall, exceeding 15% next year?
You know, Michelle, I feel like the intellectually rigorous position is almost always a bearish one. It's always easier to find more rigorous intellectual arguments for markets going down than going up, which is ironic because markets go up 71% of the time. And the reason they go up 71% of the time is because Western economies have been brilliant at creating value and making people bid stocks up because the economy performs well and grows. And I wouldn't want to bet against that. Most of the prognosticators I've seen the last week at all the major banks have predicted anywhere from a 0 to 15% return in the market in 2023. Most of the best investors that I respect a lot, some of whom are my friends, were looking for a 40 to 55% bear market. We haven't even come close to that yet. They've been very bearish about everything. I really don't share either one of those views. I think we're going to have a hard first half of the year, and we're going to have a more drawdown in the market. But I see a rally into the end of 2023, and probably a pretty flat year, which is going to be disappointing to some of your viewers, but I think would set us up brilliantly for 2024. I think the bull market will come back with a vengeance in 2024, 2025.
The bull market will come back with a vengeance in 2024. I like that positive spin, George. I want to get into some of your specific calls for 2023, but before I do that, I would like to emphasize the fact that we're talking to you because of your impressive track record and because you've had several correct calls in previous years and certainly in 2022. So let's focus on that first. What have been some of your best calls this year?
Well, you have to have some humility and say that luck has a part to do with it, because we really don't know how the world's going to turn out. You get things wrong a lot of the time as well. But we're very bullish on commodities. We think that in inflationary periods of time and when there's scarcity, and there's a lot of government-induced scarcity right now, that commodities perform well. Prices go higher. Supply comes up. People need more commodities. And you've seen crazy prices in Europe and Asia, and now starting to see semblances of that in the U.S. So we're very bullish there. And if you look at the historical track record, commodities perform better than anything in inflationary periods. We're also very bullish on value stocks. We think that value stocks have a huge delta to growth stocks in terms of their prices, and that they are much more conservatively positioned than growth stocks and are likely to outperform growth stocks going forward. And we also, for the first time in a decade, and to be clear, we've been wrong about this for several years, we're very bullish on emerging markets. We think it's time for emerging markets to really sing in the coming 3 to 5 years, and that they will outperform the U.S. So those would be 3 areas that we would really focus on.
That's going forward, and I do want to dissect that in great detail, but I do want to just get a quick recap of 2022. What have been some of the positions that you've taken that have yielded good results?
We have been very long upstream oil companies and upstream natural gas companies, and I want to differentiate because some companies focus on oil and some focus on natural gas. We've been very long midstream pipeline companies that move energy around, and those have done extremely well, and they still yield between 6 and 10%. And we've had a heavy overweight to value stocks and small cap stocks, and they've outperformed as well. We've really pivoted away from growth stocks and technology for now. I'm very eager to get back in, but I think it's still a bit early. If you look at the trading action around Amazon and Google and Microsoft and Salesforce and some of the major technology leaders, is still very bearish and very negative, and they've got probably some tough earnings comparisons still to come because their margins are getting compressed due to all the inflation. So we're going to pivot to growth at some point in the next 6 to 18 months, but we're not there yet.
Okay, so you have a big focus on commodities. Let's break that down. What specifically? Mostly energy commodities?
Yeah, we think energy commodities are more liquid. They're easier to trade. I don't really have any professional expertise that gives me an edge in things as esoteric as copper or steel or wheat or corn or some of these other commodities that are traded very actively by people who do it all the time. But I do know an awful lot about energy, and I do know an awful lot about supply and demand. And the U.S. administration is trying to artificially reduce supply at a time when China comes back online after COVID, as the world starts to grow again. When we get through this tough cycle, there's going to be more and more demand for energy. And right now, 81% of the world's energy is from oil and gas, and that will put pressure on these commodities to go higher in price, which will be very good for the companies that produce them. And I think that we're going to enter a super cycle, a secular bull market for these commodities in the next 3 to 5 years. I think it's set up beautifully for that. And we also, one last point, I know I'm going on with this, but we've had 10 years of heavy underinvestment in oil and gas because there's been so much volatility in the commodity prices and so much governmental pressure and in opposition to increasing supply. So that hasn't changed, and you can't catch up in a year or two. It's going to take multiple years to get enough energy, not just through fossil fuels, but also through wind, solar, hydro, everything else to satisfy the world's demand. The world is very thirsty for energy, and there's not enough of it right now.
So you're taking a big position in energy-focused commodities, oil and gas next year, but are you doing that through futures? Are you doing that through taking a position in specific companies? How exactly are you positioning yourself to take advantage of what you see is the surge that you anticipate in both oil and gas?
Michelle, I've called myself for the last decade a chicken energy investor. And what I mean by that is a lot of upstream producers of energy have to borrow a whole lot of money to drill wells because it's a very, very expensive thing to do. And if the commodity goes the wrong direction, you could be in financial distress very quickly because your balance sheet is so out of kilter. So what I like to do is buy oil and gas minerals on the private markets, which is you own the land that the companies drill on and you receive a royalty stream for that. You receive roughly 25% of the revenue off a well and you have no debt. It's all owned by cash equity. So you have no financial risk. So you can just wait till you generate income off of that. That's been very, very successful for us. We're also very long some of the companies that have incredible balance sheets, investment grade ratings, little debt, or repairing their balance sheets and buying back lots of stock. So you have a lot of financial leverage on your side because they're not overburdened by debt and they have tons of free cash flow that they can use to take the company private, pay large dividends, or pay down their debt to zero.
Are you able to give us some specifics on those, the companies that you're looking at by name?
I'd be happy to. I think people who won't give specifics are playing hide the ball, and that's not fair to an audience who wants specific ideas. I own Antero Resources, which is the second largest natural gas producer in the Marcellus Utica shale play, which is the largest gas field in the world. I've owned ConocoPhillips for a long time. I think it's incredibly well managed and it's a great company. I like Occidental Petroleum. I think the CEO was vilified during the pandemic, and Carl Icahn in particular. And Warren Buffett's made a huge bet on her, and I think she's managing that company beautifully. I would just also add, for people who want more safety, there's some pipeline companies that are investment grade, have huge balance sheets, and throw off gigantic cash flow, and they're very safe ways to earn 6 to 9% on a dividend stream every year, and yet get some capital appreciation well. And I'd mentioned Enterprise Product Partners out of Houston, Energy Transfer out of Dallas, and Kinder Morgan out of Houston. Those are all great companies.
I do know offhand that Antero is up over 90% or so year to date. So that was certainly a very good call there. George, given the complexity of commodities, especially when it comes into geopolitics, which play a big role in oil and natural gas markets, I mean, that makes the trade increasingly difficult to predict or to forecast. And I want to focus a little bit on some of the caps that we've seen coming out of Europe. Let's start off with oil. Europe and the G7 recently agreeing to a price cap of $60 per barrel on Russian oil. How do you see that impacting oil prices in 2023?
It's ironic because they're probably trying to punish the Russians and make the markets more stable, and they're probably going to make them less stable because when governments get involved in the markets, governments just don't have enough dry powder individually or even collectively to influence markets, which are just trillions and trillions of dollars of liquidity out there. So I think the markets will respond far more to inadequate supply or increasing demand, especially from China, when they end their lockdown COVID policies than from this government manipulation and an attempt to structure the markets the way they want it. I don't think it's going to work.
Well, on the Chinese oil angle, we do know that President Xi Jinping has been trying very aggressively to end the petrodollar monopoly. He had a recent diplomatic charm offensive in Saudi Arabia, and he wrapped it up by promising to buy more oil and gas from Gulf Arab states. But he has been calling publicly for energy trade to be settled in the Chinese yuan for the first time. So trying to get the end of the petrodollar, we've got many observers saying that this could lead to a bifurcated energy market, with the West relying on pricing in IMEX and other exchanges, the BRICS and other countries potentially negotiating bilateral oil agreements. So to some degree, what we're already seeing Russia and India doing. How likely is it that we see a bifurcated oil market in the near future, perhaps even in 2023?
Well, what you just brought up, as you know, is a critical geopolitical question, really probably even more than an economic question. And I would wish Chairman Xi all the luck in the world in getting the world to pivot to the yuan instead of the petrodollar. I don't think he's going to be successful with that at all. I think there is a ton of underlying resentment against him because of the COVID situation, which I think a lot of people are pivoting towards emanating from a a laboratory in Wuhan at this point, and the Chinese not taking responsibility for their role in all that. I would say that on our side, on the United States side, because I am an American, that the Biden administration's shunning of Saudi Arabia and pivoting away from the Middle East in terms of their focus has been extremely unwise. And irrespective of what President Biden and his administration think of some of the Saudi leaders, that is a critical U.S. ally, and they should rebuild that very, very quickly. And finally, I would say the Abraham Accords is one of the greatest avenues for peace and progress in the Middle East in my lifetime, and maybe even before my lifetime. And instead of sitting on it, which is what the Biden administration has been doing, we should be expanding that, because the more cooperation we have with our friends and allies in the Middle East, the more stable the oil markets are going to be, and the more stable the global energy markets are going to be.
Right, the Abraham Accords, that historic peace agreement that the Trump administration put together between Israel and starting off with the United Arab Emirates, then adding Bahrain and Morocco. And there is some speculation that the Saudis could join the Abraham Accords. Seeing as we've drifted in this direction, do you think that that's likely?
I do. I think as soon as the king passes away, I think the crown prince will probably fall in line to do that as well. That's where the future is, and everyone knows that. And I think the Israelis are playing a very strong hand in that respect too. I think everyone knows they're the dominant economic power in the region at this point because of the miracle high-tech and venture capital economy they've created. And they've done a really good job at being polite, diplomatic, and calm with the Arab states and being patient with them on a friendship basis. And I'm highly optimistic there. And I think also one thing that nobody talks about is I think a lot of the Middle Eastern states have stopped talking about this two-state solution because it's just not happening. You know, the best thing that can happen is that the Palestinian residents of the West Bank and Gaza and all that get a much stronger economy so they can live a lot more prosperously. We ought to pivot and be focused on their economic and financial condition and not their political condition. Point.
Yeah, the startup nation, Israel as it's known, is certainly creating a lot of prosperity in the region and a bustling trade activity with the United Arab Emirates and other countries, as you quite rightly point out there, George. Let's pivot back to the United States specifically. And again, we discussed the role of government in energy. And we have, of course, the ESG, clean energy narrative, the push away from fossil fuels, the push to decarbonize very aggressively, landing most of the world in a self-inflicted energy crisis, certainly seeing that in Europe. Do you see that aggressive push away from carbons continuing to happen in the US? The Biden administration has been very vocal with its so-called war on oil and gas companies, domestic oil and gas companies. But do you see that intensifying in 2023, or perhaps staying the same, or perhaps even some sanity prevailing and scaling back the need to decarbonize that aggressively?
Well, that may be the most important issue for our economy and the well-being of the American people in the next decade. We could see it's been fascinating for me as I become an older and older adult to see collective insanity on some issues that require sobriety and sanity, and energy is one of them. It's become almost a religion or a cult among climate change advocates to just eliminate fossil fuels immediately. And you will ruin the lives of tens of millions, if not hundreds of millions of people around the world if you do that. We cannot pivot that quickly. We just don't have the ability to do so. I would also second that comment as a sequitur to say that anyone with any rationality would love to see us pivot to cleaner forms of energy over time. I think everybody hopes for that. I just think that people who have a sober-mindedness about them and care about the most vulnerable people in society who can't pay their electric bills when natural gas prices go through the roof and so forth and so on, can't pay the gas bill to drive to work, that we need to transition calmly and appropriately, and that's going to take somewhere between 15 and 35 years. It's going to take a long time, but we should move as aggressively as we can without hurting the well-being of our most vulnerable citizens at the same time.
All right, let's talk about gas. You've done well in natural gas. As we've mentioned, Europe is certainly reeling in the after effects of the Russian sanctions and some of their own self-inflicted energy pain. We've recently seen that the European Union has come up with an agreement to have a dynamic cap on natural gas prices after several months of intense negotiations. The energy ministers there agreeing to trigger a cap on the price of month-ahead natural gas futures on the Dutch title transfer facility. The benchmark's gas exchange to 180 euros per megawatt. That's $191 more or less, if it exceeds this level for more than 3 consecutive working days. We don't need to get into the exact specifics here, but again, we've got this idea of caps being triggered by leadership, by government. What impact do you think that this could have in 2023?
I think most people in government don't understand markets and don't understand supply and demand and how fast, fluid, and aggressive markets can work and flow, and that they're going to make things worse in the short term. I think in the long term, supply is going to follow demand and price, and where there is the most demand and the highest price for commodities, that's where the commodities is going to flow. And I think that this country, the United States, as well as some other countries around the world, Australia, Qatar, are going to be producing huge volumes of liquefied natural gas over the next decade. And that's going to go to the markets that give a fair deal to the people that are selling it. And the world desperately needs it, because that's the answer to Europe's problems. It's the answer to Asia's problems, because Asia is going to be an absolutely voracious consumer of natural gas, whether it's China or Japan or Korea or anybody else. And Europe and some other places would be unwise to try to artificially cap price. What they should do instead is try to grab as much supply as they possibly can. And you see this friction right now between the Germans and the Qataris and some other people who've got an awful lot of LNG, because the Germans have tried to pivot faster to clean forms of energy than we have, and they only want to sign 3 to 5 year contracts so that they can rapidly get rid of these LNG producers, giving them gas and saving their bacon, as we say in Texas, so to speak, for now, and then go to all these other forms of energy in rapid order. And that's not going to work. LNG producers have to have 10 to 20 year contracts to have a stable price for the supply of their product, because it's so expensive to produce it. So you're going to see a real dynamic push-pull and friction between all the countries of the world competing for this energy they all desperately need. And it's going to be fascinating to watch it play out.
George, we've discussed how oil and natural gas were your top performers, or certainly contributed dramatically to the great performance of your funds in 2022. Which asset or sector then do you think will be the best performing in 2023?
Well, this is boring, Michelle, and I may get a yawn out of your listeners on this one, but I'm going to say oil and gas again. If you look at charts of asset classes that perform over time, and a lot of them, they may not repeat themselves exactly, but they echo in the years. So, for instance, you'll have emerging markets in the mid-2000s, the top or the second top performing asset class for maybe 4 out of 6 years, things of that sort. In the late 90s, you had technology and growth stocks as the top performer every single year. I think we're in a super cycle for oil and gas. So I think you probably got a couple more years of very strong performance, because these companies are trading at 3 to 9 times earnings, and they're generating free cash flow yields of 15 to 30% a year. That's like what I call inevitable math. It has to drive higher prices at some point in time. And I look at some technology stocks that I really like a lot and really want to own, and they're still not inexpensive. And I think they've got more to do on the downside. So I don't think we're going to see a big rotation back into growth for another 9 to 30 months. And I don't really know exactly how long it's going to be, but something of that order. And I also still think value stocks are going to outperform, that they're going to hold up a lot better in a tough economy, and they're still super cheap too. So I think I would look to those two sectors for next year.
All right, so your best performing sector for 2023, oil and gas, and you're also looking at value stocks. Anything in particular that you're eyeing?
Well, the pipeline stocks I mentioned, and I wouldn't give one particular sector in value stocks. I would just say look for management that has a proven track record of excellence, that has very conservative balance sheets, and they're not relying on the debt markets, and they're buying back more of their stock and paying higher dividends over time. Look for companies with that kind of profile.
Do you have an outlook overall for oil for 2023, if you could hazard a guess on the price of oil?
I do, between 80 and 120. I don't think it's going to run away to the upside, because I think there's too many governmental entities and private sector influences keeping it from shooting to the moon. I also don't think it's going to fall off a cliff, even if the economy does poorly, because I think we're not putting enough supply out there.
I mean, yeah, that's the flip side of that argument: slowing growth, slowing demand. Who knows what happens with China and Chinese demand and stagflation in the US? You don't see that impacting oil and gas companies.
Yeah, I just think that when China comes back online, there's a whole lot more demand right there. And if you look at the sources of supply around the world, OPEC just does not have a margin to produce a whole lot more. They've given it all up. And here in this country, almost every major oil basin is rolling over. We're having a really hard time finding compelling wells to drill to increase the supply domestic U.S. So where's the new oil going to come from? And if demand goes up 1 to 3 million barrels, I don't know where the new supply is going to come to satisfy that demand. That calls for higher prices.
All right. You've made your case, George. You mentioned a little bit the tech sector. It has had a very tough year. I believe Cathie Wood's ARK ETF falling over 66% year to date. What is your exposure to tech at the moment?
Yeah, I'm really glad you asked that question. And again, it's nice to have the opportunity to be transparent with your viewers. I bought Amazon today. I bought Google last week. I'm trying to nibble at the best technology companies in the world because I don't have a crystal ball like we've been talking about, and I don't know when they're going to bottom. But I do know they're starting to become attractive. And I also know that historically, markets and companies tend to overshoot to the downside and the upside. So when they're in a downtrend, they tend to go farther south and further and longer than anyone would ever expect. So I'm trying to buy the best of the best, but I'm trying to buy a little bit at a time. So I've got a lot of dry powder to put into these companies if they go down another 10, 20, 30, even 40%. And that's the methodology we're following.
But you are starting to nibble at some of the bigger tech names already, as you just said.
I am. That's exactly right.
All right. I want to focus a little bit on real estate. The U.S. home builder sentiment, very gloomy. Latest data shows that confidence among U.S. single-family home builders falling for a record 12th straight month in December. The NHB Wells Fargo Housing Market Index dropping 2 points to 31 this month. To put that in perspective, a reading above 50 indicates that builders view conditions as good. So 31, very low, very gloomy sentiment there. Do you share that negative sentiment? What is your outlook on the housing market for 2023?
I don't. That's a really poignant question because these home builders have really gotten religion after the Great Recession and all the financial distress in that. And their balance sheets are very strong and they trade at very, very low multiples of price to earnings. And they're being much more prudent in how much new supply they're putting on the market. One thing everybody's, I think, forgetting with mortgage rates having soared so much in the last year and making housing unaffordable for quite a few U.S. first-time or even second-time home buyers is that we're still undersupplied across multifamily and single-family housing by about 5 million units, roughly. So there's an awful lot more supply that needs to come online. It just may be a little slower to come online than it would have been otherwise with these mortgage rates having soared and with all the gloom and doom out there in the sector. But I think the long-term prognosis for the sector is actually quite good.
The long-term prognosis, elaborate on that. If you can give me a bit of a time frame, and how good is quite good?
Yeah, I would say it's above average, above the S&P. I wouldn't say it's euphorically better than that, but I would just say that when we invest at my firm, and I think most investors are more traders than investors, and they think in 1 to 6 month time increments, and really long-term professional investors in hedge funds and long-only equity funds may think in the 1 to 3 year time frame. I like to think in 5 to 10 year time frames. I don't like to sell securities. I don't like to pay taxes. So I like to see themes that could go on for a very, very long time. And I think the best, most powerful home builders in the country probably have a good 5 to 10 year runway, although they're going to have a lot of bumps if we go into recession, if interest rates stay high, so forth and so on. But they have the balance sheets now to withstand that and to make good decisions for their shareholders and weather that. And then when the market comes roaring back again, make an awful lot more money on the back end of that. So I think they're well positioned.
All right. George, I'd like to be transparent with our viewers. We've given all of your correct calls. What has been your worst call of 2022?
Gosh, well, that's a tough one because you always make some really, really bad calls. What has been my worst call? Sticking with gold. Gold has done almost nothing this year. Expecting bonds to be a good counterweight to stocks this year. We've been shredded in the bond market just like everybody else. Bonds are down roughly 13 to 15% this year, which to my knowledge is the worst bond market year in modern financial history. It's just been awful, and we completely missed that. We've lost about 8 to 10% for our clients in bonds. We haven't lost as much as the market, but we completely missed that one. We stuck with some real estate investments too long that we've become trapped in, and I don't know quite how those are going to work out. So any professional investor who tells you with a straight face they get everything right and they never make mistakes is just flat out lying to you. And so run away from people like that because we all make mistakes, and those have been some of mine this year.
And that's why we listen to you, George, because of your direct, forthright, and honest approach. So I'm going to go back to your best performing asset of 2023, oil and gas stocks. What could derail that narrative? What could make that investment hypothesis go terribly wrong, do you think?
Well, there could be several things. There's always a flip side argument to a bullish or bearish case on anything. And I think that, ironically, if you get a Republican administration from 2024 on in the U.S. that is highly conducive to drilling and provides these private companies lots of permits on public lands and is very encouraging to drill, baby, as the cliche is, we could get way too much. You could get way too much supply online, and that would crush commodity prices and crush all these stocks. So that's one. The second would be that these producers don't show discipline and they start drilling like crazy again and raising supply, and that would crush the price of the commodity and crush all these stocks as well. So I think discipline on the private side, the government in place on the public side. Ironically, the Biden administration is very, very good for the oil and gas industry because they make it so hard to bring on new supply. I think those would be the two major things. I don't think that the demand for energy or the scarcity of energy going forward right now, because we haven't transitioned effectively yet. We still need fossil fuels, but we're kind of having a hard time finding enough of those, are all very bullish. But it could go upside down. A very severe recession would be one more thing they could disrupt.
Yeah. And, then that also brings up the question of what does the Fed do? Because if 2020 taught us anything, George, it's expect the unexpected. If there is some kind of a black swan event in 2023, does the Fed have any means of addressing it? Are there any arrows left in the quiver at all to deal with a 2023 black swan unforeseen event?
They're pretty dry at this point. I think that it would be very difficult for them unless inflation got really tame really fast to pivot down and start slashing interest rates again and just be too disruptive too fast. So I think they're about out of ammunition. And again, if it were me and Chairman Powell gives me a call, which he's not going to, and says, what do I do? I would say, Mr. Chairman, raise 75 basis points in February. Yeah. And say you're done for 6 months. And in 6 months, you'll reevaluate whether to raise more or start cutting. I think the market would rally like crazy if he did that.
And it would give investors clarity. Markets hate uncertainty. If you know where you stand, that would help a lot of companies position accordingly. You touched on gold, George, saying that was one of your bad calls for 2022. You would expect gold to perform well in a high inflation environment with a lot of geopolitical risk. Why do you think gold did so poorly or not as well as you expected in 2022 rather, and what do you expect for gold in 2023?
I'm actually bullish on gold. I may be wrong again next year on it, but I think it's due for a 20% rally. We'll see. I don't think it rallied this year and had a very, very mediocre year in an inflationary environment because I think a lot of people substituted crypto and Bitcoin and all that for gold as their inflation proxy because they thought that would be a bet against fiat currencies. And if they had inflation that reduced the value of fiat currencies, their crypto would make up for it. And obviously, crypto has been an unmitigated disaster this year, not just in terms of price declines, but in terms of fraud and bad behavior and everything else. And I think a lot of money that should have poured into gold as an inflation had poured into that. And now that's been not quite wiped out, but eviscerated this year. I think there's a whole lot less capital to flow to gold. And I think there's a great degree of skepticism that gold is an inflation-fighting asset class anymore.
So you see 20% to the upside in gold for 2023?
I do. I think it's overdue for a rally, but I could prove to be wrong with that.
Gold disappointing investors. People were certainly expecting more of a rally in gold this year, but relative to the markets, relative to other asset classes, gold is holding steady down around 1.3%. So it didn't shoot up to the upside, but is maintaining its value. Let's move on, George, to what you think will be the worst performing asset class or sector in 2023. I have a feeling I know what you're going to say here, but what do you expect will be the worst performing sector or asset class in 2023?
Yeah, for me, it's still going to be growth stocks. And then I would also put crypto in there. I don't think that the carnage in crypto is over. And I think the investable case for that has gone downhill. So I would be very cautious about those two areas. And I have a contrarian bet that I want to just put out there is crazy. And I don't advocate anybody doing this as well. But I've got a small, very speculative investment in Eastern Europe right now, because I think once the Ukrainian Russian situation steadies itself out, that I think Poland and Hungary and some of those other countries in there, the Czech Republic, are going to have a massive rally. So I wouldn't recommend anybody do that, but I've got a very small position in there because I think the future's bright there once all this gets resolved.
And do you think there could be a resolution to the Russia-Ukraine conflict in 2023?
I think it'll be death by exhaustion or some kind of ceasefire or treaty. I don't expect it soon, but I think that there's a lot of exhaustion on both sides of that. And there might be even a wild card of regime change at some point. But I don't think this can play out forever because it's so value destructive for both of those countries.
All right, so we could see a diplomatic solution to the Russia-Ukraine conflict in 2023. That, of course, would be a very positive development for the new year. We're going to wrap it up on that positive note. George Seay, thank you so much for joining us. Let's see if your forecasts do indeed materialize in 2023. Thanks for joining us.
My pleasure, Michelle. It's always good to be with you. Thank you for all the good questions.
All right, I appreciate your insights, so thank you again, and thank you for watching. I'm Michelle Makori, and this is Kitco News Outlook 2023. Keep it right here.